Welcome to Talk Tickers. If you were watching the market on November 12th, you probably saw something. Well, pretty strange with BitFuFu. Ticker FUFU.
Yeah, it was a head-scratcher. They dropped their Q3 25 earnings before the bell, and honestly, they looked fantastic. Probably the best results we've seen across the whole digital mining sector this quarter.
Right. The stock jumped immediately, like 10, maybe 12% in the pre-market. Looked set for a great day.
And then, nope, market opens and the stock just tanks. Finished the day down, 8.5%?
Exactly. That massive swing, that gap between really strong fundamentals and how the market reacted, that's what we're digging into today.
For sure. And this quarter landed at a really critical time. Bitcoin prices were high, averaging around $114,500, which sounds great. But network difficulty was also hitting record highs. So post-halving, this was a huge test for miners, especially for FUFU's whole dual engine sort of asset-light approach they talk about.
Okay, so our mission here is simple. Cut through that paradox. We'll give you the numbers, the ones that seem to really back up management strategy.
And then we'll try to unpack what might have spooked investors, the things that led to that weird intraday sell-off.
Let's start with the highlights, because honestly, the numbers themselves were pretty explosive.
Yeah, no kidding. If you were looking for that turning point for them, this was it.
Revenue basically doubled year over year, up 100.1%, hit $180.7 million.
Which just crushed consensus estimates. We're talking like $45 to $50 million above what Wall Street expected. A huge beat.
But okay, revenue is one thing. The bottom line, that's often where the real story is, right?
Yeah.
Especially for these guys.
Absolutely. And that's where you see the shift. Non-GAAP earnings per share came in at 6 cents.
Which was double the Zacks consensus of 3 cents. 100% beat there, too.
And maybe the most important thing for anyone holding this stock long term, they actually made money. A proper profit. Net income of $11.6 million.
A huge swing from losing $5 million just the year before.
That's the definition of hitting scale, controlling costs, and finding profitability even when the mining environment is tough.
Okay, so $180 million in revenue is massive. Let's unpack that a bit. Where did it come from? Was it just high Bitcoin prices boosting their own mining? Or did that cloud services model they pitch actually deliver?
It really looks like validation for the asset-light strategy. The mix tells the story. Cloud mining, that's their service fee business, right? That was the giant slice.
How much?
$122.9 million. So 68% of the total revenue.
Wow. Okay, so almost 2/3 of that record revenue came from sticky service fees, not just mining Bitcoin themselves. That feels, well, different. More stable maybe than some other miners.
That's the argument, exactly. It's a different model. Self-mining was much smaller, $20.1 million, so about 11%. Equipment sales were pretty strong too, $35.8 million, or 20%.
And that cloud focus helped margins.
It seems so. Adjusted EBITDA hit $22.1 million. That's 4 times higher than last year, implying a margin around 12%. Pretty solid.
But wait a sec. If cloud mining is the big driver, and that means paying for power and hosting for customers, wouldn't their costs just scale right alongside revenue? How did they boost the margin if the main cost scales directly?
Good question. So yes, the cost of revenue did go up significantly with sales. You have to pay for the power for those cloud contracts, right? It came in at $173.5 million, which is really close to the $180.7 million revenue.
So thin gross margins then.
On a GAAP basis, yeah, pretty thin. But the profitability lever, the beat, came from controlling other costs. Operating expenses were way down, 52.6% lower year over year.
How they manage that?
Management pointed mainly to lower stock-based compensation. That's a non-cash charge, right? So when you look at the non-GAAP numbers, which strip that out, the picture looks much stronger. It shows real discipline on the cash operating costs as they grow.
Got it. And this dual engine thing, it sounds like it showed some real flexibility this quarter. They said cloud demand was actually higher than what they had set aside for it.
Yeah, they basically had more customers wanting cloud contracts than they had dedicated machines for.
So what did they do? Turn customers away?
Nope. They use their own mining fleet. This is that structural advantage they keep highlighting. They confirmed they took about 38% of their own self-mining hash rate.
38%? That's a lot.
It is. And they redirected it to fulfill those cloud contracts instead of mining Bitcoin for their own balance sheet.
Hold on. So they chose not to mine Bitcoin for themselves, potentially missing out on adding BTC to their treasury?
Right.
To instead serve as a cloud customer, likely because those contracts have better or at least more predictable margins.
That's exactly the implication. It suggests they're prioritizing locking in that recurring service revenue, even if it means slightly slower growth in their own Bitcoin holdings right now.
Yeah.
It signals they see themselves as a platform first, maybe a miner second.
Interesting strategic choice. Okay, what about customer metrics then? If the cloud service is key, how's that looking?
Pretty strong. Operationally, they scaled up capacity to 36 exahash per second. That's up over 37% year over year.
End users.
Cloud mining users crossed 641,000. But the number that really jumps out, especially if you care about stickiness,
Let me guess, net dollar retention.
bingo, nearly 120% in cloud mining.
120% NDR. Wow. Okay, so existing customers aren't just staying, they're spending more money with FUFU. About 20 cents more on the dollar this year versus last.
In this sector, with all the volatility and competition, yeah, that 120% NDR is gold. It speaks volumes about platform satisfaction.
And they have the financial foundation to support this. Balance sheet, okay.
Looks very solid. They ended the quarter with $254.8 million in cash and digital assets combined.
Including Bitcoin.
Yep, including 1,962 Bitcoin held in treasury. That's a significant cushion, gives them a lot of flexibility.
Okay, so let's recap the fundamentals. Huge revenue beat, flipped to profitable, the dual engine model worked, great customer retention, solid balance sheet. Seems like a home run quarter.
Absolutely. On paper, it looked fantastic.
Yeah. Which brings us back to the big question. Why on earth did the stock spike pre-market and then close down 8.5%? This is where things get maybe a bit more nuanced for investors paying close attention.
Right. It's that disconnect. Management's painting this picture of a strong, resilient platform, but the market action suggests, well, something else was weighing on investors' minds. Primarily, I think dilution concerns and maybe the structure of those margins.
Before we get to those headwinds, did management offer any forward-looking stuff? Any catalysts they pointed to?
Yeah, they laid out 3 main strategic directions they're pushing, trying to differentiate themselves from just being another hash rate provider.
Okay, like what?
First, RWA, or real-world assets. Tokenization. They're looking into ways to use their Bitcoin holdings as collateral for new financial products, basically tokenizing assets backed by their BTC.
The goal there being?
More stable funding, hopefully non-dilutive, plus potentially new fee streams from financial services built on their crypto assets. It's an attempt to add a whole financial layer.
Interesting. What else?
Second, and this could be huge for their costs, cheaper power. They specifically mentioned a deal in Canada using natural gas.
Natural gas power. Tell me more about that. Why Canada? Why gas?
Well, securing low-cost power is like the holy grail for miners right now, especially with difficulty so high. Moving to natural gas, potentially in a colder place like Canada, gives them a few potential edges.
Like what?
Potentially much lower and more stable unit costs for power compared to relying just on the grid, which can be expensive and volatile. Plus, it might help them sidestep some regulatory pressures around grid usage and carbon footprint. It's about building a resilient, low-cost foundation.
And they gave a timeline on that.
They sounded optimistic, said they expect a definitive agreement within, quote, the coming month. So pretty soon.
Okay, that could be a major structural advantage if they pull it off. What was the third thing?
HPC and AI, everyone's talking about pivoting mining infrastructure to high-performance computing.
Right. Seems like every miner is announcing an AI strategy.
Exactly. But FUFU management sounded, well, more cautious. They said they're evaluating it carefully and moving deliberately. The subtext seemed to be they want to protect their economics and not just rush into an expensive pivot like some others might be doing without a clear path to profit.
Okay, so RWA, cheaper power via Canadian gas, and a cautious look at HPC. Those are the potential upsides. Now let's tackle the downside that seemed to dominate the trading day. Why the sell-off?
Well, first you have to remember the context. FUFU stock has massively underperformed the rest of the sector this year.
How badly?
It was down like 41% year-to-date going into the call, while the main miner ETF, WGMI, was up over 125%. That's a huge divergence, over 160 points of underperformance.
Ouch. So sellers were maybe already lined up, just waiting for a reason or any pop to get out.
That's likely part of it. Institutional skepticism was probably high, and then the call gave them maybe 2 specific things to latch onto.
What were they?
First, those margins we talked about. Yes, non-GAAP looked great because of lower stock comp. But the GAAP numbers showed cost of revenue, $173.05, eating up almost all the actual revenue. $180.07.
Leading to thin GAAP profitability.
Exactly. And short-term traders, maybe focusing just on that basic GAAP margin, might have seen that as a lack of immediate operating leverage. Despite the huge sales growth, it might have spooked them.
Okay, margin structure. What was the second friction point?
Dilution. Always a concern with miners.
They mentioned their ATM program, right? The at-the-market offering.
Yeah, they have a big $150 million ATM facility set up, and they confirmed they'd recently used it to raise about $6 million in cash.
Now, is that them being desperate for cash or just hopping up the tank opportunistically?
Management would argue it's smart financing, right? Getting cash on the balance sheet before potentially committing to a big capital project like that Canadian gas facility, it makes strategic sense.
But the market hates dilution, period.
Pretty much. Any whiff of shares being sold via an ATM, especially after a stock pops in the pre-market, can trigger selling pressure. Investors just factor in that downward pressure.
So putting it all together, management pitches a strong, resilient platform story backed by solid numbers.
But the market focuses on the existing massive underperformance, the thin GAAP margins in the immediate term, and the fear of more dilution from that ATM program, all against the backdrop of punishingly high network difficulty.
Okay, so that brings us to the interesting part for someone looking at this situation. How might you play this kind of disconnect? And just a reminder to everyone listening, this next part is purely for discussion and educational purposes. It is absolutely not financial advice.
Right, disclaimer firmly in place. Look, given that huge underperformance, the fact that the cloud business is showing strong fundamentals with that 120% NDR and these potential catalysts like the gas deal, you could argue the selling might be overdone. The stock's trading near low valuation multiples despite the beat.
So you're thinking some kind of bet that the market's got it wrong and that the strategic stuff will eventually win out.
Sort of, yeah. But maybe a structured way to play it. A long volatility strategy, perhaps. Something that tries to capture the upside if they execute, but maybe hedges some broader sector risks.
Okay, lay it out for us. What's the outrageous but plausible trade idea?
All right, so the structure could be something like this. You go short the broader Bitcoin miner ETF, WGMI.
Okay, why short the ETF?
That's your hedge. If Bitcoin tanks or network difficulty keeps crushing everyone, or regulators crack down on the whole sector, the short WGMI helps protect you from that systemic risk that drags all miners down.
Okay, short the sector. Then what?
Then simultaneously, you go long FUFU stock itself. That's your core bet that the company's specific story is strong.
Right.
And you add some leverage to that bet by buying long-dated, out-of-the-money FUFU call options, maybe something like the $5 strike calls, with 6 to 9 months until expiration.
Okay, short the sector ETF, long the stock, long out-of-the-money calls. Walk me through the logic there. Why all three pieces?
The short WGMI caps your downside if the whole mining thesis sours. The long stock is your main position. The long calls are where you get the explosive upside if FUFU delivers on its unique strategy.
How so?
If they announce that Canadian gas deal is done, locking in structurally lower power costs, or if they make real progress on that RO tokenization stuff, those are things specific to FUFU that their peers might not have.
Differentiator.
Exactly. News like that could cause FUFU stock to suddenly re-rate higher, potentially much faster than the rest of the sector. It could finally start closing that massive 160% plus performance gap we talked about. The calls give you leveraged exposure to that potential sudden gap up based on qualitative execution. It's a bet that their strategy will break them away from the struggling pack.
A very specific, structured bet on management actually delivering on those catalysts. Interesting.
It's definitely not a simple buy and hold. It's playing the divergence and betting on execution.
Okay, so let's wrap this up. Fundamentally, Q3 looked really strong for BitFuFu. Record revenue, return to profitability, the dual engine model, especially cloud, seems to be working with that impressive NDR.
Yeah, the numbers themselves validated a lot of what management has been saying. They look like they're building a real scaled platform that can generate cash.
But the big question left hanging, the one for you listening to think about, is about that crazy stock reaction, that huge intraday reversal on massive volume.
Yeah.
Was that just temporary, pre-market profit-taking, meeting sector pessimism?
Or is the market sending a deeper signal? Is it saying that the overhang from that $150 million ATM, the potential for future dilution, combined with those structurally thin JAP margins, are those bigger hurdles than even $180 million in revenue and 120% NDR can easily overcome right now?
The next quarter's results, especially the margin details after this potential Canadian gas deal comes into play. That feels like it'll be absolutely critical to watch. That could really determine if the market starts believing the differentiation story.
Absolutely. That'll be the next big test. A really fascinating situation unfolding here.
Indeed. Well, that's our deep dive for today. Thanks for joining us as we unpack the BitFuFu Q3 earnings call paradox. We definitely encourage you to keep following this story.